Let's get going here. We're a few minutes after, but that's great. Really looking forward to talking to our funding panel today. But first, thank you for joining us for the 11th Denver Startup Week. And this first session is sponsored by Madison Taylor Marketing, one of 8 programming tracks aimed at supporting the entire entrepreneurial team. And then we have our title sponsors, Amazon, Capital One Cafe, Dell for Startups, and the Downtown Denver Partnership. And then we have our other sponsors on there, Kickstart, among others. And so we've got a lot of great support here for this. All right. So today with this panel, I hope that we can learn a little bit about the VC market, what's going on, and any trends we're seeing, and how that can help founders get more investment. But let me introduce to you the panel first. We've got Ingrid Alongi, a general partner at Stage Fund. And then if you guys just want to say a little bit about your fund.
Yeah, test, is that working? Okay, I think so. Is that, yeah.
Okay. Got to hold it close.
Yeah, that's okay. Hi, everyone. Nice to see you all. Ingrid Alongi here, Boulder native, general partner at Stage Fund. We invest in kind of pre-Series B companies who have been abandoned by traditional venture capitalists or who have acquired quite a bit of debt that they can't sort of get back to growth mode. We do control investments and kind of clean up their cap tables and inject some capital and kind of are a little more hands-on and help to bring our companies back to profitability.
Great, thank you. Next we have Serene Pappenfuss with principal. She's a principal at Kickstart. Go and tell us a little bit.
Fun. All right. Hey, I'm Serene. Kickstart Fund is a Mountain West focused fund, pre-seed and seed stage. And we focus on SaaS and marketplace companies. So spend quite a bit of time in Colorado and Utah. And we love our Colorado startups. Some of them include Sondermind, Havenly, CareCar, Rook, Nomad, and many others. So if you fit the bill, then please come talk to me.
Great, thank you. Next is Adam Burrows, managing partner at Range Ventures.
Hey everybody, Adam, co-founder, managing partner at Range. We are a fund focused on pre-seed and seed Colorado companies explicitly, software tech-enabled services. And before founding Range, my partner and I collectively gone from founding to IPO, so have been on the founder side of the table, know what it's like, and have some empathy for how hard it is, and want to help enable the next generation of great Colorado builders.
And finally, we have Julian Bush, director at Denver Angels.
Yeah. Hey, everyone. I'm Julian Bush. I'm one of the 7 directors at Denver Angels. And while we're an angel group, per se, we're actually a syndication group. We focus on Seed Plus and Series A companies. Our average check size is $1 million plus. Our investment thesis is really we're looking for really growing companies. Usually have about 500K or more in trailing 12 months of revenue, growing substantially year over year. That's really our sweet spot. And really no focus on industry or vertical.
Thank you. And I'm Craig Swadek. I'm a director, one of the directors with Diane Bailey at Founder Institute. We are a pre-seed accelerator. We help founders at the earliest stage all the way up when they've got revenue to get them accelerating their revenue, but also getting them investor ready. So with that, all right. So we've got some great things going on in Colorado. We've got Denver had $1.9 billion in funding for the second quarter, which we've heard before, so it was more than double the first quarter. Colorado still ranks 9th in total funding. But one thing that caught my eye was we are #1 in the state, or #1 in the country, for women entrepreneurs. And I wanted to see, what do you think about that? What do you think drives that? What's so good about Colorado? Ingrid, or I'm going to start with Ingrid.
I'm happy to start.
Yeah.
So I didn't give that much of my background, but I'm also a founder. I started a software services company in 2010 called Quick Left, and so as a female founder, I felt very encouraged and welcomed here in the Boulder, Denver area. I think. I had come back. I went to San Diego for graduate school, and there, in order to kind of get into a crowd, you had to drive a certain car, you had to live in a certain place. And when I moved back to Boulder to work for a Foundry-funded company, Bradfeld came and said hello to me. It was very, I was given a lot of credit for the things that I could do and not necessarily what I was driving, and I really appreciated that. And the other thing I think that really helped is the early beginnings of events like this. A lot of people really encouraged this kind of community, and there was a lot of opportunities to work with other founders and get mentorship, and I think that really just lifted up the entire community. So I really felt like I both contributed to and benefited from that community aspect in my first company and now in my second one as well.
Great. Yeah. Serene?
I'm not handing it to you because you're a woman.
No, I get it. Ingrid said, I'm not handing it to you because you're a woman. I was ready to take the mic. I think it's a great question by Craig. And, before I answer the question, I want to acknowledge that we have a ways to go. Call it, $6 billion was raised in venture funding in 2021 collectively in the state. And about a sixth of that was women co-founded startups, and women only was only about 146 million. So quite different from, the $6 billion number. But that being said, it is apparently one of the top states for women-led startups. And why? I don't really know, but I think part of that is a visibility thing. And I think about generational change that comes from the startups that came before and the people who shouldered this before us. And one of many examples of that, I was talking with Jen Knight on Monday, CTO and co-founder of Agent Sync, and they're one of the big raises or startups that went through with the big raises in 2021. And she is just one of many people where, women see that and they're like, I could do that too, whether it's a CEO or CTO. So I think visibility certainly helps, as well as, women or other investors who support women intentionally.
Great, thank you. Wanted to move along to a little bit more to the venture capital market in general. I was looking at some numbers where the mega funds of $1 billion or more made up 64% of the funding this year, and they've never been more than 34%. So kind of wanted to get our panelists' input on that, and then give us a take on the overall trends in the market and everything. Adam, do you want to
Sure.
start us off? Sorry to put you on the spot there.
How do you define a mega fund? I mean, a fund over $1 billion?
Yeah, a fund's over $1 billion. Yeah.
Yeah. So that's been a trend the last few years. A lot of if you've heard of the term crossover funds, led by Tiger Global, traditionally hedge funds raising just gigantic venture funds. I mean, SoftBank did this way back in the day, and a lot of those funds. I mean, I don't know the stats and how they break down specifically, Craig, but a lot of those funds were pouring a ton of money into the market, particularly at the later stage. Obviously, it's been well publicized. That stage is hurting really bad right now. I think all that valuation pain that you see in the public markets has filtered down all the way to the seed stage, and there's been kind of a reset after what was a pretty frothy 2021 across the board. That said, there's still a lot of dry powder out there. I mean, a lot of funds were raised before. There's a tremendous amount of innovation happening, as you can see by, what's going on in Denver Startup Week, and just I find it inspiring. All the companies. I mean, I think I met 50 companies yesterday of everybody doing super cool stuff. And so, the market ebbs and flows in this regard, and people tend to, I think, overreact and overshoot high and overshoot low. But there's still funding happening. There's a lot of just price discovery going on right now in terms of, what does the new seed round look like? What does the new A round look like? But, these things just go in cycles.
Great.
I think it's a mixed reaction that I get on this question. I mean, I mentioned Agents Think. There's Guild, Sierra Space, et cetera, that raised really big rounds in 2021. And, you know, SoftBank, Tiger, Coatue, et cetera, they came into many of these rounds in Colorado. And overall, it's a fantastic thing. If, you know, the more the merrier in many ways. I think the big risk is over-reliance. And, you know, the positive thing I view is we don't have, you know, a lot of great growth equity, for instance, shops here in the state. There's just not enough, you know, growth or private equity money to go around to all the startups. And so it's great when we have outsiders coming in and coastal funds that are paying attention. I think the scary thing, and you saw this with Tiger Global and SoftBank this past year, is that they have exposure to public stocks. And so when the public markets tumble, that affects how they can support their own startups that are private later on. And so that's the scary thing is, you know, does Tiger keep investing in deals in Colorado and then disappear the next year, right? So I think that's the thing we got to be cognizant of, careful of in years moving forward.
How do you think that affects founders in their investing? Do they need to change how they're going after VC funds, or pretty much stays the same, or what do you think?
So I think it depends what stage you're at. I think what you're talking about with mega funds specifically is much more at the later stage. You did start to see some of these mega funds coming downstream, and what I mean by downstream is starting to go earlier in seed and making option bets, right? So if you're a multi-billion-dollar fund, you just go, hey, we'll throw $500,000 checks all over the place, or $1 million, and that can seem really appealing to founders because oftentimes those came with less diligence, but they also come with less assistance. And something that, you know, I say, and I'm sure, you know, the folks at Kickstart say too, and what can be a self-serving way, but we all genuinely believe it and see it operate every day, is if you're early stage, if you have choices, you want to take money from an investor who's truly a partner and has career risk just like you do, right? Who's really all in and going to do everything they can to make it work. If you're just one of, you know, 500 different companies that doesn't actually have a partner to support you, you get money, but that's about it.
Well, exactly, and that's sort of where we come in too. And what we're seeing a lot more of is those founders who have taken some of this funding, who are being abandoned, and they don't have, you know, capital to bridge, you know, to their next payroll or whatever it is, and so they're really finding themselves without that advocate within the firm to support them when things kind of get rough.
Just kind of going back to the original question, I think you were talking about like mega funds are getting a lot more funding currently, right?
Yeah.
So I kind of see that as like more of a trigger and just investors' hesitancy in like the economy, right? Just like with normal stocks, they're going to take their money out of really risky stocks and put them into more, you know, more risk-adverse kind of long-term bonds and everything. Just like with investors, that's the same thing with VC, right? They might pull their money out of, you know, smaller funds and put it into large mega funds because I think that's more risk-adverse, just because they don't understand what the economy is going to look like in 2023. So yeah.
Great, thank you. I want to switch it up a little bit here. I want to get down to the founders and really talk. Well, I want to spend some time on here and really help founders understand what they need to do to get VC funding. So if I'm a founder and I'm talking to investors, what should I look for in a VC firm, in a partner? And what maybe due diligence should I do as a founder on the fund that might be investing in me?
Well, first of all, you should definitely do due diligence, right? It seems obvious. A lot of people don't do that. A couple things that we would you know, encourage you to do. One is, ideally, find a partner, as I said, who has career risk themselves, right? So a partner at either a small fund that's trying to make it, person who's maybe hasn't had a big hit at a fund for a while, somebody who's new at a fund, who really, really, really wants your company, needs your company to succeed, to be successful themselves. I think they're going to be generally the most helpful on that. Also, I would ask every single fund is going to say, hey, we're value add, right? We're going to help you. I would ask them for specifics, because it's table stakes to just say, hey, like, I'm a helpful person. I know know lots of stuff. I've got a good network. Great, everybody does, okay? What specifically are you going to do, aside from just you being great, to actually add value to my business? And they should be able to give specific examples. And then the third thing I would say is you should back channel diligence, talk to portfolio companies that aren't the ones that they're going to send you to, and ideally ones that aren't really their top performing companies, right? How are they going to act when your company's just doing okay or not even doing well at all? That's really the test of a true partner.
Yeah, I think just adding to that too, just looking at kind of what kind of companies does that venture firm invest in? You know, are there other kind of ways that you can partner or network with their other portfolio companies? Like, how do they have some kind of support there, which is also really helpful as well. And I really like the back channel comment too, because I think really understanding where you're going to be when you kind of get into trouble and what that firm is going to be able to do to help and what their track record is. I think as a founder, when you're really struggling to make your company go, kind of all you care about is, I just need the money in my bank account so I can make payroll. And that is when you get those really bad deals, and you now have this person on your board who is not helpful, or who takes what I have seen, because we sort of get the companies as they're kind of going to almost failure level. We get board members who will take the companies into the wrong direction, or they don't really know the market, and so they'll give advice with the power of a board vote to take the company in a certain direction, and it's the wrong direction, and it's really the founder's fault that the company didn't succeed. So just really understanding who are you going to be sitting next to in that boardroom making official decisions with is important.
I'm going to third, I don't know, what do you say when it's like seconding but thirding? I don't know. The back channel reference comment that Adam originally made. Absolutely do that. I would hope that any of my founders would say, yes, like when things were hard, Serene hustled and opened up customer intros. She introduced me to so many Series A founders. I would hope that they would say that. And we encourage, folks that are in late stages of due diligence, please check that you actually want to partner with us. In many ways, it's a marriage, right? It's not just capital. The thing I always say to founders is that the three things you're getting is capital, community, and expertise. Ingrid touched a lot on community, so I won't beat a dead horse there, but expertise is another important thing. If you're a prop tech investor, a fintech investor, healthcare, HRIT, whatever it is, push your investor on what is your track record here? How many of those companies were acquired? Was it a strategic? Tell me about how those companies went. Why do they offer unique expertise on the vertical or category that you're operating in? Because that can make an immense difference in terms of intros, the path that you should take, et cetera.
Julian, do you have something to add?
I'll add something here, but I won't forth the same. I'll give you guys a little bit of tips. If I was in your shoes, this is how I would look for my funder or my VC partner. Any founders here, raise your hand if you guys have seen the Colorado Startup Ecosystem Canvas document. Yeah, that's way less than I actually thought. So if you haven't seen that document, I think it's coloradostartups.org/ecosystem canvas. It lays out every single, VC, angel investor, everyone in the Colorado ecosystem. Definitely go there first, and then I'd go through all the VCs, I'd go through all the angels. I would pick my top 10 that are going to be as close to similar as their portfolio and their investment thesis, and I would reach out to them, right? Because you don't want to spend too much time fundraising. You don't want to stop the growth of your company. You really want to be precise with your time. So definitely Colorado Startup Ecosystem Canvas, I would go there. Surprise, 99% of the room's not using it. So.
Great tip, great idea. You're right. Fundraising can take over a founder, and that can take all of your time, and sometimes it can. So, knowing that, what's the best way for a founder to start talking to a potential investor? When should they start, and what should they do?
When their product is perfect and ready to reveal. Right.
Is it ever perfect?
No, definitely. I mean, we all had a laugh, and we all know we're supposed to kind of iterate and get feedback. But you'd be surprised how many people I talk to that are friends that are starting a thing and they're not ready. Oh yes, especially women who are not ready to talk to investors. So, I offer to give them intros to these early stage seed fund investors, and they're like, whoa, not ready yet. And I kind of get a little bit taken aback because I'm like, wait, don't we all know that we're supposed to build these relationships long before we actually need the funding? And it's helpful to get this feedback. And it still is hard. It's hard to put yourself out there and get criticism. And I do agree that women have a harder time with that. So I'll hand that.
Yeah. Funny but not funny, but I don't know how many of y'all are on Twitter, but I think about the funny tweet that's circulating that's like, God give me the confidence of, and it's like a white male founder pitching on just an idea or whatever. And it is real. Like, I see so many women who are like, I'll come to you in like 5 months when I'm ready. And I'm like, let's just talk. I don't care if you're fundraising. Let's talk about your idea. To expound on that question, I think another way of thinking about it is like, how do I stand out to the investors? And I think a dirty secret of VC is you stand out so much more if you have an LP or an existing portfolio founder making that warm intro. I think warm intros, first and foremost, helps so much. If you can find a mutual connection on LinkedIn, whatever it is, goes a long ways. But if it's one of those two categories, like, it's going to go up in the inbox or the priority list. The second thing is, this goes back to the question of like back channeling your potential investor, is do research on your investor, like look at their portfolio site, see, where they've invested in your existing category. And, when I get a lot of inbounds via Twitter, email, et cetera, but when I see that someone has put together a thoughtful email where they're like, Serene, I see that you've invested in X company, I'm a SaaS and marketplace company, and I see that you can provide expertise, I'm going to bump up that email because I'm like, whoa, Ingrid's done her research, and yeah, I could be a good partner. Like, I see this is a better match. Like, put thought into the email to show, like, I'm not just looking for you for capital, I'm looking for you for your expertise, for your community, et cetera.
Yeah, particularly, I totally echo that. I mean, particularly at the early stage, we don't have a lot where we invest. We don't have a lot to go on. One of the things we're evaluating is, how'd you get to us, right? To Serene's point, did it come through a referral? Because that's how you're going to ultimately get to customers. It's how you're ultimately going to get to talent when you're recruiting people. Like, I want to see how you operate. And so I think, to Serene's point, if I get a really thoughtful email, that shows somebody who's really savvy. And so when I, in the future, if I'm an investor in that company, say, hey, we should go target this person to bring on as a COO, they're going to probably be just as effective at trying to recruit that candidate. So,
Julian?
Yeah, a little bit different because our investment thesis is 500K of trailing 12 months of revenue. We do have that revenue threshold, but that doesn't mean to wait until you hit that threshold, right? I forget the number off the top of my head, but I think 80 to 90% of our portfolio were founders that reached out to us early, and they were too early for our investment thesis, and we worked with them, 2, 6 months, a year, and then invested in that company later down the road, right? And then to play devil's advocate on this side, right? I think one of the things that personally frustrates, a lot of the directors at Denver Angels is when a founder comes to us and says, "There's 30 days left on our close. Either jump in or don't." I think we all have a diligence process that definitely takes, multiple months. And sometimes when we get labeled in as angels, I think there's an incentivization there. But plan ahead, I think, is the biggest thing. Don't set yourself in a box that you have 30 days and someone pulled out and now you have this and you want to close. Like, definitely give yourself time and engage investors early, for sure.
Great advice. I mean, it sounds like you can start early as long as you're doing your research and put up a good front, I guess, that you actually know what you're talking about. Well, let's just say that you do get funding, and there's usually multiple rounds for funding. What does your crystal ball say about where we're going to be in 2, 3, 4 years?
I don't have a crystal ball, and anybody who says they do is full of it. So all I know is that great companies are going to continue to get built. and the best founders are the most ambitious, scrappiest founders are gonna keep doing really well. And that's who we're looking to back. I actually wrote a blog post about this because it actually is a pet peeve of mine, seeing all these VCs that have become like macro economists and saying, hey, don't go raise now, wait 6 months, don't do that. Like, these are the same people 6 months ago or a year ago who were writing checks at ridiculous valuations. Nobody knows anything except focus on what you can control, build a great company, raise capital when you need to. The capital is still there. Deals are getting done. People are a little bit pickier now, but the best deals are still getting done.
Yeah, and I think it's for me, it's actually helpful. So when I acquire venture-backed companies and tell them that they have to get to cash flow break even, it's really a stressful conversation. And what's been helpful about this time is that actually this conversation is being had in the larger venture-backed startup community, and so it makes my job definitely a little bit easier. But it's true, focus on being a good company, focus on your target market, your customers, and just being smart with your capital. And those are going to be the companies that do rise to the occasion. And yes, deals are definitely still happening.
So we're investors at Kickstart in Omni, AUMNI, and they're basically fund management data. So they have visibility into all the fundraisers that are happening, at what valuations, and they aggregate that data, and we get to see that. And at the end of Q2, Tony sent over data that showed that fewer deals were being done in Q2 of this year versus Q1, but valuations were on par, if not a little bit higher, which is a little bit unintuitive, especially with how public markets and later stage venture has been performing in the last half year. I anticipate, again, who knows what's going to happen. If I'm to look in my own crystal ball, my theory is that we'll start feeling it in seed stage in the next 12 months, but we have yet to meaningfully see change so far.
Yeah, I think honestly the amount of innovation that's happening in investments is pretty crazy right now. And in 3 to 5 years, I think founders will have a lot easier time finding funding. I mean, Carta just spun up this new platform where anyone can kind of start their own VC now, which is pretty crazy. And crowdfunding's growing. All these different kind of funding avenues for founders is growing. So yeah, I just honestly think founders are going to have a lot easier time finding money through different outlets, for sure.
That's good news for founders. So at Founder Instill, we have a 14-week program, and it's interesting. The founders that come to us start off with, all I need is money. That's all I need is money, and my idea will take off and everything else. And then about halfway through, or a little earlier, we talk about traction and how important that is and what that looks like. It takes different, it looks differently to different founders and startups. Can you talk about the importance of traction and what you look for traction with your companies you invest in?
Yeah. I guess, yeah, mine is really clean. It's our investment thesis is based upon traction, right? It's a revenue threshold. It's 500K of trailing 12 months of revenue, growing year over year by 100%. Those are kind of like our investment thesis. So we really look for traction, and that's really where we kind of first engage, and that's our benchmark. Doesn't mean that you can't reach out to us before. We love to work with you and get you to that stage and then keep following you. So with traction, it's like 100% important for us. That's kind of entirely what we look at. So yeah, absolutely.
Yeah, I think we're pre-seed and seed. So we'll invest as early as somebody with an idea. That's not the usual state, but we will, right? And so I think most funds that are seed funds, Denver Angels is a bit of an exception, really will invest as early, theoretically, as somebody with an idea. So when Range or somebody else tells you, hey, it's too early, being super honest, that means it's too early for your company. Why? Because you don't have enough traction. When we're looking at a company, we look at a bunch of different factors. If somebody's built 3 successful startups before, they're coming in the same space, they've got the same team, that's somebody that we can take a chance on because they don't have traction with that particular product. They have traction individually and with an experience set. If somebody's new to an industry, first-time startup, we want to see more traction usually in the form of users, revenue, customers, whatever it may be. And it just shows that like you've actually got some of that product market fit that we can say, okay, we can see what this looks like.
And I think too, I want to make a comment too about just accelerators and things like Founders Institute. I think that I'll talk to a lot of founders who are maybe they've been in the startup ecosystem. They know how things work, and they're kind of seasoned, aka older, and they'll be like, oh, I don't need one of those. I know what I'm doing. I've got a 20-year career in software and blah blah blah. And I'm always like, why wouldn't you go to an accelerator and just get access to investors and access to a community? It just seems like you could shortcut so many things. So even though you might have a very great career and a lot of experience, I would definitely open myself up to some of these opportunities to kind of shortcut your way. It's not like you necessarily have a network of all kinds of investors. It's another kind of great way to just get FaceTime with people that can help you get that funding you need.
So this question on traction is interesting. I think another dirty secret of VC is that the best time to fundraise is when you have what's called a halo effect. So that can be month over month ARR growth. That can be MAUs, DAUs, or monthly active users, et cetera, on marketplace if that's the kind of business you are. If you have seasonality and you know that a bulk of your sales is going to hit in Q4, you should probably fundraise on the tail end of Q4 or Q1, showing that you had amazing sales, not in Q2. So being mindful of when that is for your business, try to capture that halo effect so you can tell an effective story to your potential investors.
Great advice. I want to know, as investors, what keeps you guys up at night? What's spinning in your head in the middle of the night if you wake up?
Y'all look like you're really sleep deprived.
My kids?
What was that?
Our children?
Children, yeah. I think. Yeah, I think what keeps me up at night would be, it is probably macro, even though it's something that's out of our control. And even though I said there are going to be great companies that get built no matter what, I have total confidence in that. Macro is a huge deal, and none of us can control it, and none of us can influence it. And so I think personally, like my partner and I, we focus on what we can control. We tell founders, focus on what you can control. But hey, we're all going to rise and fall, with broader economic and global stuff going on.
Oh, honestly, yeah. Nothing really keeping me up at night currently. Just recently got married, so I've been sleeping really well.
You've got that to keep you up at night.
No kids yet, soon, but yeah, it's been great. And just to ditto what Adam said, I think keeping our eye on the what 2023 looks like, I think is important. And just trying to mitigate risk. I think that's probably what I'm sort of keeping up at night recently. But yeah.
My kids are a little older, so they're not keeping me up at night anymore. They're wonderful. I think what keeps me up at night, so since the state at which the company is in when we acquire them is a little bit more stressful, and I tend to be more on the portfolio side and in the companies and helping them through this process. So I definitely take on, I think, some of their worries and stress, and my hope is to really help them through this time, and that their company doesn't have to die, and we've got companies doing really well right now, so it works, but it is I give a lot of emotional support. As a founder, I can really identify with what they're feeling. But I will say, even though sometimes making payroll is still a thing that I worry about, it's very different worrying about it for my portfolio companies than it was when it was my company. And it really, every time we're at those moments, I'm like, oh man, this is not as bad as it was when I had Quick left, and I really worried about disappointing my employees, and everyone's going to leave, and I'm going to have to sell my house, So I think while there's still stresses, just having that experience, I can now be there for my founders in a way that I feel like I can redeem myself from my payroll worries when I had my company.
Yeah, I think emotional support's a very real thing. Yeah, part of being an investor or board member is just being there as a sounding board. And I'm reticent to say the word therapist since that's a very real and serious profession that we're not. But yeah, that's a big part of the job. I think something that I think about a lot these days is just runway. And you mentioned this concept of making payroll, and I am a believer in the CEO founders are the ultimate decision makers. Like the destiny should be in their hands. Like, we're not the operators, but I do think about their issues a lot. And right now, given market conditions, founders are having to face a lot of tough decisions right now on, are they going to do the hard thing? Are they going to do the RIF? How are they going to handle making payroll, et cetera? So yeah, it's just ruminating on these questions of, will the founder do the hard thing?
Great. One more question before we go to Q&A for the audience. So deal flow is pretty important. So you guys see many things, as many startups that you can. Where do you get your deal flow? Where do you find most of the companies that you invest in?
Tell us your secrets.
Mine aren't secret. We get a lot of our deal flow actually from lenders, from banks, some alternate banks. Silicon Valley Bank, Avid Bank. When you get venture funding, you don't go to your normal bank down the street. There's lenders that's are specialize in venture-backed companies, and those lenders then have a special assets portfolio or something like that, and they have covenants that give them quite a bit of power. So this is maybe some more advice, is when you are taking loans and looking at some of these other kind of ways to get extra capital, just really you need to really understand what you're giving them, because it's pretty serious. So the lenders really have a lot of control over what can happen next if a company isn't able to service their loans, and they'll come to us and we'll do some debt recovery, we'll take on the rest of the loan, we'll do a bunch of very creative things so that the company can focus back on growth instead of this very scary, loans are scary situation. So, and then of course what we were hopeful is that we will get more referrals from other founders, and we're starting to get that as we're having some successes. And it doesn't have to be like a bad thing that you have to come to a firm like ours. It can actually be really exciting to kind of get your company back and do what you set out to do without all these sort of burdens.
I think pretty straightforward it's a lot of different sources, and it's primarily word of mouth. Right, it's primarily reputation. Which one of the things I actually love about this business and being an investor is our deal flow, as Craig mentioned, deal flow is the lifeblood of our industry, right? We need to be seeing great companies, and the only way we're going to do that is if we do great work for founders, such that they'll refer us, because it's founders, it's LPs, it's other funds, right? So making sure we're doing great work so that other funds are saying, hey, I want Range, they're going to do really great for my company, and same with founders. So it's really, it's all of you. And Denver Startup Week, of course, right? That's for
Definitely. Yeah, so deal flow for us, I feel really fortunate that, our kind of syndication group model, we have 7 directors. So we unleash those 7 directors in many things that we can do. And then not only that, we have one real rock star director. If you see her over there, Kaylin, she's at every event. And she really is our deal flow pipeline. So if you haven't met her, definitely talk to her, or one of us. But yeah, she's a champ, and she worked probably the hardest working woman I've met. So you're the best.
Serene?
Yeah, same thing as many of the things have been mentioned, whether it's Twitter, inbound emails, word of mouth, referrals. But one other pro tip that I wanted to mention is ending conversations with the question of, who else should I talk to? Who else do you recommend? In many cases, investors pass on deals to each other, where it's like, this isn't a fit for us, it's a little too early, or we don't specialize we do consumer, but just as an example, we don't do as much, D2C. I think, Ingrid or Adam, et cetera, would be a great fit for this. we pass on deals to each other. And so asking that question of who else in your ecosystem is really good at this. And that's why it's truly called an ecosystem, right? There's so many folks that participate as part of this, whether it's on the debt, equity, et cetera side. So ask that question because you never know who can open what door.
Great, thank you. All great advice. Love it. So now let's go to our audience. Raise your hand if you have any questions, and we'll figure out a way to get a microphone to you.
Or they can come up.
Oh, right here. Okay.
My question is, you mentioned accelerators earlier. What's the advantage of an accelerator? You gave a piece of that, but what are you walking into with an accelerator, like you're just talking about doing your due diligence with a venture capitalist?
Yeah, I think that's a really great question. I think accelerators are such a great resource, but you do want to make sure you're going to a good one. I think there's, just like code schools, there were a bunch of bad ones, and you had to really know which ones to hire from. And so similar to accelerators, you want to really make sure that you're getting kind of, your program's worth, your money's worth, you're giving away equity. But I think being able to talk to people who have experience with go-to-market strategies is one of the best aspects of an accelerator. Having a network of investors to talk to will keep, raising money takes so long, and to not have to go through LinkedIn and go down the list and figure out how to get an intro and all that stuff is just a huge advantage. You guys have other? I'm
going to add one thing, which is a warning for, so Techstars is great locally, right? Techstars based here. We've invested in Techstars companies. I've been a mentor. I don't know if you have, it's an awesome community, so they're great. Y Combinator, obviously, everybody knows. Not all, as Ingrid said, not all accelerators are created equally. We actually worked with one founder recently who was in a accelerator. It almost felt like, if anybody's seen Silicon Valley, like an evil Ehrlich Bachman bedroom kind of situation, where the founder was just totally taken advantage of and kind of sold a bag of goods. So again, not all created equally. They can be great, but make sure you know what you're getting into.
Just one more point on that, especially if you're a first-time founder. I think Adam brought up the point, if you have multiple companies, I think an accelerator can really lend to giving you a lot more risk aversion with investors because you're going through that program, right? You're learning all the education, you're learning how to go to market, all those things. So if you're a first-time founder, I think accelerators are highly important for you, especially for a seed round.
We happen to think so too, but did you want to add or just?
No, that's fine.
Any other questions? Raise your hand. One in the back there. Let me come up to you.
You're too close. Yeah.
Sorry. Here you go. This question is maybe more for Ingrid, but just wondering from the group as well, what advice do you have for founders who maybe struck out in their initial search for funding and how they can kind of try again the next time?
Yeah, so the question was, what advice for founders who struck out when they first tried funding? So I actually did not raise money when I started Quick Left. Quick Left was a services business, so I really did have to get creative and kind of find other ways to get working capital and kind of keep my business growing. So there's certainly a lot of SBA programs. I got an SBA loan and I bought my office space in downtown Boulder, which then later bought me a house in Boulder when I sold it. I mean, it certainly wasn't the VC route, but it was a great outlet for me. So, looking at sort of different grant programs, traditional banks may have something depending on what your service or product is. VC is definitely not the only direction that you have to go. You guys have opinions on that?
Yeah, I think tons of different ways to think about it. There's no right answer, but for one, there's so many VCs across the country. You don't have to stick to the ones in your own backyard. So, never think that you can never raise capital. I think the second thing is that, I know I shouldn't be saying this as a VC, but bootstrapping is very underrated. I have a friend who sold his business at 100 million ARR and made just as much money as a founder who sold for more than $1 billion because he was able to retain, how much he owned of his own business. So, if it's possible, I know that's like very difficult and it's, easier said than done, but bootstrapping is definitely an option too.
Any other, we're over here.
So primarily for Ingrid, but anybody, being that you work with like distressed companies, is there a theme to what their failures were either in people or processes that when you take over, that's the first thing you focus on?
I was just talking about that right before the panel. There's actually a lot of reasons that companies will come to us, and it's not like, so one thing I get from I have to do my own fundraising, so my LPs is like, why would I want to invest in broken toys? And I'm always like, what? They're not broken. You just can't see. So, there's a lot of things. So for instance, if we get our companies from lenders, a lot of times if you've got to make a $40,000 a month loan payment along with payroll and all the other things, it's really hard to grow. It's hard to invest that into marketing and sales and customer development. Another thing that could happen is sometimes we get VCs who've got a portfolio and they've had a big exit, and then they just kind of want to like soft land the rest because they want to move on. There's a lot of investor fatigue where, especially with technology companies with a lot of deep tech, which I love as an engineer, you spend a lot of your capital on building the platform, and so just as you're getting that momentum in the market, the VCs are like, we've been doing this for too long, we're kind of done. And what I see is like, wow, the tech is done, and now all I have to do is like sales and marketing, like sign me up. So, it's, investors are human too. So there's a lot of reasons. Of course, there are times where we've got founders who went in a bunch of different directions. They had bad board members, and they just got themselves into trouble, and they're fatigued and done, and they want to move on to something else. There's a whole host of reasons we see of failed companies. But having gone through it myself, I just don't. Mistakes and failures are fixable, redeemable. So.
Anyone else have more comments?
That's great. I mean, I'll say, your job as a founder is don't run out of money. That's how companies fail. They run out of money, right? So it's an easy answer, but
back to the money.
In all seriousness, though, people lose sight of that, right? And controlling your own destiny, and even knowing, I think this is a great reality check what's happening now for a lot of founders, which is even if you're in growth mode, you're burning money, you should know in the back of your mind, okay, like where could I pull back if I absolutely had to and still keep operating this? Because I've seen a lot of business, I'm sure you all have too, that like were left for dead, right? Barely survived, but they could just keep hanging on, and they waited it out long enough to figure it out, and then they became a huge winner where all of their competitors went by the wayside.
More questions right here.
Thank you. Hi, I just want to talk a little bit about something Serene said earlier. You said that a good follow-up question is who in your ecosystem would be good for me. I always get nervous at the end of a conversation that I feel like someone's going to feel like they're being tasked by me, or, and I don't know how to get the goodness out of the, you know what I mean? I think I did this to you the other night, actually.
No, I was very happy to help you the other night.
But so is that universal, that everybody is happy for you to ask those follow-up questions?
That's a great question. And by the way, I know you just asked a question, and I was talking about bootstrapping a few minutes earlier. If I said bootstrapping is overrated, I meant underrated. I don't know if I said it the opposite way, so I just want to clear that up. It's a great question. So we met the other night, and I realized that her business wasn't something that I could invest in, but I was like, oh, I actually have multiple people in my network I could totally introduce you to, and I genuinely meant that. I think, first of all, make people work for you. I think it's totally fine. I have no shame in that, and being like, who else should I talk to? Like, it opened doors for me. I think, Adam made a point earlier today of like, investors want to see that people can hustle. And even though, like, I'm not, trying to gauge that about you, prove to yourself that you can do that, right? Like, it's okay to ask people that. I think the other thing, too, is that hopefully through that interaction you saw like, oh, Serene can't invest in me, but she just did something kind for me. And my hope is that like that is good for my reputation, that the next person that speaks to you is like, hey, what do you think of Serene as an investor? My hope is that you'd be like, she couldn't invest in me, but she introduced me to 3 different people, right? That's something that hopefully all VCs are cognizant of, is that like at the end of the day, like our product is partially our reputation. And so definitely don't be afraid to ask.
Yeah, and I think it's just part of the culture. Like nobody doesn't expect that question at the end of a conversation. It's kind of like we have this ecosystem, and that is as good as saying hello and goodbye from my conversations.
All right, so one here, and then we've got one up there.
5th time's a charm. We talked earlier that like when it comes to women and BIPOC founders, I mean, it's low single digits, and we want to celebrate 140 million, but it's like, what is it like in your opinion that's contributing to that? Like, what do we need to do better? Is it the cojones to get in the room in the first place and the confidence to ask all the questions, or is it like in the tactics of what we're pitching or what we're building or once we're there?
Let me go all the way back to my graduate degree in women's studies and talk about so many institutionalized sexism. No, it's so funny because I get asked this question and I have like the credentials, but I think when you're in it, like I don't even realize maybe that I'm being sort of read a different way than sort of my male counterparts. I don't realize until maybe somebody in the room like, Ingrid, did you see how they were acting towards you? And I'm like, nope. And I think that's my superpower. But to just sort of not get the joke, I guess. But I think it's just going to take time. And I think as we sort of look at reinvesting and as we grow in our careers and have our opportunities, I mean, the first thing I did when I started my software company was try to figure out how to hire more women engineers, and turns out it didn't happen by magic just because I was the founder. I really had to work hard at looking at our interview process and so many things. So I think it's just there's a lot of different things that need to happen to make things better, but I think we in this Denver community I think I have a very optimistic view on kind of where we're at and how we all work together and how people like us have been able to, be invited to these stages. These organizers do such a good job trying to include us in our opinions, and it's going to take time, but I think we're really doing all the little things in every little place that we can to kind of help that. Not just because you're a woman, but
Got another question, I think, gentleman in the black shirt, yeah. Hope I don't trip.
There you go. Thanks for coming. Hi, we're going through the fundraising process right now, and just wondering, for consumer apps, I mean, we've been talking to a lot of VCs, and we hear from some VCs, come back when you have this kind of revenue. Some other VCs say, come back when you have this kind of traction or this kind of virality, or the K factor is this number or whatever. Is there a secret formula for that, or is that just something that every VC sees differently?
It's the latter. It's the latter. I mean, people ask me that all the time. They'll say, "Hey, so how much revenue at the point like when I get this, are you going to invest?" Like, no, right? I don't. Maybe, but there's not a secret formula that gets you there. It's a aggregation of different factors that in an early stage, right? If you're at a growth stage, if you're raising a Series C or Series D, it can definitely be much more formulaic, and it's much more about the numbers. The earlier you go, it's more just about finding an investor who believes in the same crazy idea that you do, and showing that investor enough proof, whatever that means, that gets them to say, I'm in, right? And we tell founders a lot of times, one reason why we pass genuinely is we say, you seem great, the idea seems great, we're just not as passionate about what you're doing as you are, and you deserve, and I mean this for all founders, if you have the option, you deserve a partner who's as passionate about the crazy irrational thing that you want to go do as you are, because like I think somebody said, you're signing up for a marriage here, right? And so I think, it's a long way of saying, don't get focused on what investors are saying they want in terms of specific numbers. Build a great business that you think and is a great business. Talk to enough investors, you'll find the right partner.
All right, final question.
Great. Okay, cool. Could you give us a sense of the kind of your 12 months from a macro point of view, not macroeconomics, but like when you look at a year-long calendar, I know that like September to November is a big investment season, and January to March, and I don't know, could you just put some more kind of color and information into that?
Well, summers are kind of light in my world. Kids are on vacation, out of school, and so a lot of investors go with their families and take their breaks. So that's when, and Thanksgiving through Christmas is a little slow as well on what I see in funding land.
I have a little bit of a different view on this, which is I think that's right. Generally, like in conventional wisdom, I think investors should work just as hard as their companies. And so I think that the good investors I know, if there's a company they're interested in, I don't care if you're on vacation in Europe, I don't care where you are, like you're going to jump on it, right? And that's the kind of investor that you want, that when you're having a hard time with your company, like you don't want to, it's summer, I can't talk to my investor. I mean, that's crazy, right? So I actually think in a weird way, that time of year, the slow times of year can really be a true test of who you actually want as an investor.
Great, thank you. Here's my co-director who I work with at Founder Institute. She has an event tomorrow. I want you guys to know about it.
So now that you guys are all jazzed up about raising some capital, and then you're thinking, oh crap, there's this thing called a term sheet. WTF with the term sheet. Tomorrow, right here at 2:30, we are doing a mock term sheet and negotiation. Blair is here in the audience. Blair is with Frontier Venture Capital. We also will have Marlo Vernon with Care Penguin. So we will have a founder who is raising her Series A, and we have a venture capitalist who are going to go through the term sheet alongside Bold Legal. Bold Legal is our legal partner for Founder Institute. So when you go through our program, we walk you through the process of getting your Delaware C Corp, as well as answer any questions about this thing called a term sheet. So it's going to be a very informative event. Again, you want to be here tomorrow at 2:30.
Sounds like fun, Diane. Hey, thank you so much. It's fantastic. Thank you for coming. Great questions. And that's it. Have a great night.
Blair said I should talk to you about a potential co-invest. I can email you later.
Oh, okay.
People want to talk about things.
Ingrid.